So in the last video, we spoke about the global financial crisis of 2008 and we tried to relate to the Indian context so that maybe it might help you guys understand more of the crux of the matter. Because we got a lot of students who watched The Big Short, who watched documentaries, who've read up on it, or even have spoken to people who have actually been through the 2008 crisis, and most students are still unable to really process what happened. So to make it even more relatable, we've said that okay, what happened, we made a video, but now what has happened since then to prevent this is another video which we're going to talk about. Here are 4 points what has been happening so that we don't make the same mistake again. Point number 1, banks have become safer even at the cost of profitability. So what does that mean? If you remember, in the previous video we said that normal people like you and me would go and deposit our money in the bank, and that bank would use this money to buy risky assets. In 2008, those were the mortgages. So that taking people's money, putting it with other operations, hoping that they'll make returns from all sides, was a mistake. That has been separated and segregated in most banks, which means in all banks I think, which means that the bank has 2 arms now, for example, 2 verticals, right? One is the retail vertical, which is our deposits, and the other is these investments and all of that they make. So they cannot mix the money now. So no matter what happens to the bank, how far it goes into risk, they cannot play around with the money which is from customers as deposits. This is one of those things that they've done, right? Another thing would be, for example, banks have to keep a capital reserve. It's called CRR. They have to keep a certain percentage of their money liquid so that if such events take place, they can make sure that they survive and people's money is not destroyed completely. But now that amount which used to be there has been increased so that there is more money with the bank, which means earlier the bank would take that money, use it in other ways to get more returns. But now the world has said no, keep little more money with you, it's okay, we don't want such high returns, we want to be safer rather than take risks for such higher returns. So these are the kind of things that they've tried to do to be safe, which has actually costed them profitability at times. But as you've seen over the last 12 years, nothing, at least there's been no repetition exactly like this. However, we've also spoken about, scams such as Nirav Modi's PNB scam. So there are still chances that it might not happen at a global level, but these things can happen. It's extremely important, guys, for us to understand and know what to do with the money that you will end up earning. It's very important that you understand financial planning. In fact, if you guys want, we can make a video on the basics of financial planning so you can get started. But most importantly, guys, people need to be financially literate. So if you are, for example, studying with us or studying anything which is finance related, okay, good, you've taken the first step. If you haven't, please understand that financial literacy will save you a long way in your life. Not only you, but your entire family's wealth will be preserved, hopefully, when you understand concepts of diversification, of matching goals with what returns you require, with understanding your risk return appetite. So there are a lot of things which you must understand, right? So that was about what banks are doing as their first step. Second step, they are globally becoming less interconnected. Now, this does not mean that globalization is going backwards. What it means is, if you remember, again in the previous video, we spoke that investment banks like Goldman Sachs or Lehman Brothers or Bear Stearns, to buy these risky assets, what they did was they borrowed a lot of money from different countries. And that time, countries were very happy to pour money into different countries because they expected more returns. When Lehman Brothers or Bear Stearns went bankrupt, all the money they had borrowed basically was not going to be paid back. So that entire global capital flow basically has become less. People said, okay, let's invest more into our country where we have more control over what happens to the economy versus in another country. Of course it happens, but it's just reduced. And if you see, for example, China, right? China has banned, first of all, it kicked out Uber, right? It has banned companies such as Facebook, I think even Google. So it's sort of stemmed from the financial crisis, that it's better to stay into our country as far as possible. Even if you're making, there's outflow into other countries, it's fine, just be safer about it. That is point number two. Point number three, this is something which was more coming, right? So it is the change in the corporate culture. So there's top level management, and then there's middle, and then there's low, depending on the size of the organization. In 2008, the people at the top of the banks who come up over the years, they were under the impression that we don't have to worry about what lower management thinks, we don't have to ask them questions, decisions has to be made by the top level management. Which is unfortunate, because the real work of talking to customers happens with the lower or the mid management, and their views were not taken into account with the top management. This is not for the crisis. This has been a problem since a long time. All business books, management books, MBAs are taught that even if you reach the top level, please understand not to take the lower people for granted, because they talk to customers. The best example, Jeff Bezos, okay, the richest man of one of the most successful, richest man in the world, with one of the most successful companies in the world, Amazon. He calls Amazon Earth's most customer-centric company. Why? He says that most people focus on competitors, we focus on customers. And in fact, I've read, I don't know how, whether it was once in a while or once in a week, but he makes other people in other departments sit for customer service calls every now and then, so that all people understand what customers are talking, what problems they face, what do they like, what do they dislike, and the entire company from top to bottom have a complete understanding of the customer's feedback. Focus on customers, you'll be able to get a lot of things right? 180 some billion dollars today. So the richest man for a reason, right? Okay. And the fourth point is credit rating agencies. So I have not explained the details of credit rating agencies, but essentially there are a few credit rating agencies in the world. You must have heard about Moody's or Fitch. These people, what their job is, they go to each investment avenue, okay, and they will study it and they will grade it based on the riskiness of the asset, which means, so let's say they look at a bank account. They look at a bank, right? Now we know that the bank is generally comparatively less risky, quite safe. So they'll give the bank an A. Okay, this bank is good. If you put money, you'll get it back. But you also know that, okay, there's a lower return because there's lower risk. Then they might have, they'll probably rate some bond, they'll rate some stock. They can rate anything. They rate entire countries basically, right? And they give grades, right? From AAA to, I don't know how the lowest is, it can be C, D, God knows what, right? Their job was that those buildings, if you remember the Lora buildings which we spoke about, where investment banks were actually buying those assets and then selling it to insurance companies and hedge funds, that had to be rated by the credit rating agency. Now if you remember, there was a building which was given as mortgages to the really unqualified McDonald's workers who were not going to be able to repay the cost, repay the EMIs. They were going to default, and that financial asset was very risky for these banks. In fact, for the insurance companies and the hedge funds as well. So that actually had to be rated really low on the chart. It was supposed to be downgraded. So when investment banks would go to a credit rating agency, which was necessary, the credit rating agency was going to downgrade it. But they get fees for rating this. So if I am Lehman Brothers or I'm Goldman Sachs, I'm telling them you have to rate a lot of these assets and they get a lot of fees. But if they rate it bad, I'm going to go to the competitor. So all credit rating agencies obviously want fees. They don't want us to go to the competitors. So by default, they have to ensure that the rating is given well. So I continue giving them more and more fees, bringing more assets for them to rate, making sure this company thrives. Otherwise, I just have the option. So if they say, no, this is a bad asset, I'll say, you know what, forget it. I'll go to the next one. Now, this was a huge flaw in the plan, right? If this was not there, a lot of people would have hopefully studied and known that these assets are risky, may have prevented the entire crisis. So since then, what has happened is the world has tried to set up more credit rating agencies, have tried to make sure that they are not really threatened by giving genuine ethical ratings to these risky assets for the good of the entire customer base, investors, everybody. This is one thing which has not really taken place well across the world, but at least we're trying to go into that direction. So guys, these are the four major points about what's happened since then. I hope that now the financial crisis from then till now made sense to you all. And if there's anything else that you would like to know, please let us know. We'd be happy to make it. Thank you.